Hey trader, Stephen Quitzel here. It's Thursday, July the 5th. Hope everyone had a good 4th of July. I'm going to hop right into the market. Sorry, we did not have a webinar last week. I was in Omaha watching the Razorbacks lose the national championship, but I'm back and ready to go now. So let's get right into it. There is a ton of going on. The dollar and the gold are at a major inflection point. A lot of the international markets are literally just breaking down, breaking support, getting their death crosses. So I want to go through everything just to make sure that you're aware of those international markets. There's a lot of there's a couple of commodities that are moving, so we're going to look, and there's some strong sectors creeping up. So we're going to look at just absolutely everything today. Let's get started in the NASDAQ. Now, I want to get started in the NASDAQ because it's very interesting. You have this kind of grind higher now. So I measured this peak back in January, the drop was almost 12%. Then it went up 15%. Then it dropped 12% again. Then it went up 15% again. So I don't know if I'm not saying it's going to drop 12%, but I'm saying the last two times it's dropped 12% and gained 15%. And what I do know is you have a gap right here that just tried to get filled and rolled over. You have a gap right here that led to further downside. And then we have a gap right here. So to me right now, it's just, if we look at, the trend that is happening, and then we're going to look at the international markets, I think there's plenty of reason to be cautious. Now, I try to stay a bull as long as I can. That doesn't mean that I won't buy stocks that I believe are setting up. But all I'm saying is right now you have some nasty action going on. And now this is just a pullback. So, if this is a 4 or 5% pullback, that's not that big of a deal. I'm kind of looking at what's happened the last two times. The market has gapped down to get a potential, see if that happens again. Because one thing I remember in 2015, when the market was just chopping up and chopping down, for the first 6 to 8 months, and then it rolled over. Well, that first 6 to 8 months, it kept following it. Up 3% gets slammed down. Up 3% gets slammed down. Now, up, 15% gets slammed 12. That's not a fun ride, but we have to take cautious of this gap right here. The declining 20-day EMA, the rejection 1, 2, 3 times. Now the market is up today, and we do have I do believe we have a Fed announcement. But I think what is worth taking note is that you have several days where you had the market started strong, then finished weak. Then you had Friday, market started strong and finished weak. Tuesday, before the market closed for the 4th of July, market started strong and finished weak. So I tend to try to make my trading decisions in the second half of the day for this reason, especially when it's just a trading rule I came up with. I used to, the market would start high, gap out. I used to buy growth stocks coming out in the morning and they'd roll over by the afternoon. So I just made a decision. One of my trading rules is I try to wait till, at least within 2 hours to the market closes to try to make sure if something starts strong, I want it to finish strong. And right now we have a market that continues to start strong and finish weak. And given what has happened here, all I'm saying is just, I'm not telling you to go out and sell everything, but just be cautious with new positions. If, the market starts to undercut, the 7,400 level, or your positions are getting stopped out, just let it get stopped out. It's no big deal, and wait for a potential reversal. So if this cracks right here, I'm looking for a reversal, right? And then I might back up the truck just a little bit just to see if we can get a nice bounce, right? And then I might sell a little bit into the oversold bounce. Now, and hold on to see if we get a market breakout. Now, if the NASDAQ, if this is just a normal pullback, we come back, we fill this, which is very possible. I really need the NASDAQ to break these two pivots to try to negate. It might suck me in a little bit a lot of times, though, what will happen is it'll suck everybody in, and it'll get kind of a rally, just like right here, right? It just straight V-shape, came back, sucked everybody in, shake out, and then rolled back over. So a lot of times what I will pay attention to when you get these rallies coming out of here, and they're strong and it's hard to watch them just move right past you, is I will look at, the stocks. I'll look at the index, the sectors that are moving. Is breadth moving up with it? And that's going to help me decide how much I want the market to suck me in or not. And I say suck in because that's what it does. That's exactly what it does. It gets you excited. It sucks you in. Look at right here. You had this pullback, cleared these pivots right here, gapped up, everything looking good for a nice rally. One last shakeout, little W, boom, gapped up, tradable rally. And we're getting into the summer months, so there's a lot going on in this chart, and there's plenty of recent history to look at and say, okay, what is logical? What has happened? So I'm trying to lay this all out for you to show you. It's hard to make money in stocks, growth stocks, value stocks, any stocks, unless they're really, really strong when the market is under the 20-day moving average, just because there's no rally. So typically, a lot of times when this happens, I like to find stocks showing relative strength versus the S&P 500, because typically if we can get a pop, those are the ones that are going to do the best. Sorry, I had to get a drink of coffee. Okay, so the S&P 500, it is struggling. The 20-day moving average is curling down a little bit sharper than the NASDAQ. You can see several rejections at that 20-day moving average. Now, a lot of times, if the 20-day moving average starts to curl a little bit, or at least starts to flatten, I tend to believe that I have seen that the market will break through that. So a lot of times when it gets this 45-day moving average, 45 degree down, that's a time to avoid. When it starts to curl a little bit, especially tightly under this, even though it's rejected 3 times, I'm still looking for a breakout to the upside. So just kind of keep that in mind. Even though it's got rejected 3 times, this is a cluster. So this could, I count the times the market has bounced off support, and I count the times the market has got rejected off support. And typically that, if it bounces, 1, 2, this was just a massive run. So this is almost like the fat tail of the curve. But if it gets rejected a couple good times on that third, and then it starts to curl on the third time, I'm looking for it to break out. So there's just so many mixed signals right now. So just take it day by day. Don't feel like you have to overtrade. Right now, there is something moving, I think, and we're going to talk about that in a minute. That might be an opportunity, but we're going to look at that. So you have the CRB, and then you have the dollar, right? The dollar bounced off this, 8-year trend line. It's really interesting because you have the dollar is getting up into this zone right here where it could just bust right through. It could, if it breaks through, I think it's going to have to eat its way through. There's probably a lot of dollar resistance right here. So it could have to eat its way through, or could just pull back and create a consolidation. Either way, if you look at this chart right in this zone, we're going to look at this in greater detail. Let me kind of blow this up a little bit. So you look in this zone, and then you have the CRB. Right as the dollar was entering this zone, the CRB was reversing. So, your oil, which makes up a lot of the CRB, kind of reversed at this trend line right here. So to me, it's almost like an Ali versus Fraser, like which one's going to win? Something's got to give. I kind of doubt they're both going to go up together. But the CRB, you could argue, is at support, at a trend line support, and you could argue that the dollar is at a resistance. And it hasn't really it broke this downtrend, but it hasn't really created a good consolidation and a breakout. But as you can see over here from this move, it really didn't. I mean, if that's what you, this is, you know, maybe a 2-month consolidation, and then it broke out. So I'm just really keeping my eye on this to see what is going to happen. And if you're like Steven, I know you've been looking at this for a while now. It takes a while for these ships to turn. So I want to look at international stocks, VEU. This is the All World ex-US ETF. It's just very interesting because it's negatively correlated as of, you know, the last several years with the dollar. So you have the green and red line is the VEU, and you have the dollar, which is the black line. So you can have these international stocks. It broke. This ETF broke a horizontal trend line, and it broke a this 2-year, 2+ year, almost 2.5 year trend line. Okay, that's kind of a big deal. You can see that this trend line got touched 1, 2, 3 times, and then it broke. And then it broke what, you know, you could argue is kind of a head and shoulders looking formation, and then it broke right here. Will this probably bounce back a little bit? Likely. But look at just how, and it's not exact, you can see, but look at how when this pulls back, the dollar gets strong, and then when the dollar gets weak, this gets strong, and they just cross, just like the CRB. So it just goes to show you, when the dollar makes these just long runs, when this makes the long runs, typically it means the dollar is getting weaker. Now you can see they crossed right here, and almost like an inverse mirror of each other. And now could they cross again, right? Could the dollar continue to bust through this line right here, which we were just talking about, and head higher, or are they just going to get close and then, you know, the stocks are going to go up and the dollar is going to go back down? We don't know yet. This can take a year to pan out. And I know that's frustrating because you don't like, you know, long consolidation, long bases. You just want them to take off. But the reality is a lot of this international stuff is already broken down. So we're keeping our eye on this relationship. So VEU has broken down. Emerging markets have just gotten slaughtered too. Same trend line, emerging markets. And what's interesting is you can see right here, when the emerging markets, they can definitely have a mind of their own. Yes, if the market's doing good, sometimes they can outperform, but they can go the other way based on the dollar, based on commodities. So they are correlated to, actually, I kind of like to throw on a correlation, but they are correlated to the overall market, but they can have their own mind. And obviously, you know, they have corrected. They're in a bear market. This is a death cross right here, the 50-day under the 200-day EMA. So this is a bear market. International stocks are not doing well. So it kind of makes me wonder a little bit. And the S&P and the NASDAQ, they're holding up. Okay. So you have international stocks, emerging markets, just rolling over. Negative divergence. You know, yes, you can say that it has to do with the dollar, but is the U.S. markets, are they going to be able to hold up, you know, or are they going to be the last to go? I have no idea. And we'll just kind of have to wait and see. But I do know that typically, most of the time, if the world stocks are going to pull back, you know, there is a positive correlation. Actually, I think what I want to do real quick is go back and look at the correlation between the VEU and the S&P 500. Let's go. Yeah, so there's a lot of correlation with the VEU and the S&P 500. So yes, there's periods of negative correlation. So if there's so much correlation between international stocks and US stocks, and they most of the time move in tandem, and the fact that international stocks have already broken down, are they going to drag the S&P 500 down, or is this just a dollar rally that's dragging the international stocks down? I don't know, but it's worth noting how correlated over the last 5 years that the U.S. and international stocks have been. They are moving very closely in tandem. So We just looked at emerging markets. Let's look at China real quick. So you have the Shanghai Stock Exchange. Boy, this does not look good for the Shanghai market. Maybe it's the trade wars, but to be fair, I mean, this was breaking down probably way before then. This is, just a massive, more than double type of move in the market in a year and a half for the Shanghai. It's what they do. They get just parabolic. And then you have this rising wedge. So this broke. Okay, now you have another trend line. It's just getting longer. This broke, and maybe the trade war talks is the straw that broke the camel's back. I don't know. Could it come all the way down to here? Yes, but all I know is emerging markets, Shanghai, like all these indexes are getting incredibly weak. Now, the Shanghai, if we look at the correlation, I feel pretty positive that you're not going to see as much correlation on this one. Come on. Yeah, you're not going to see as much correlation on the S&P 500 with the Shanghai. It's all over the place. And that's fine, right? Because this looks ugly. So I don't want to be too correlated to that. But the more developed economies that are in the VEU, they are highly correlated and they are breaking down. So all this is just, it is very much worth paying attention to. And it's getting really, really interesting. Now, let's just go back to the dollar, the USD. This is a weekly chart. Downtrend, clear as day, broke out. This 94.86 right here, it's back in this zone. It's trying to eat its way through this. I don't know if this is going to break up or break down, but we're going to look at the gold in a second. Is also at, this is at resistance and gold is at support. So it's just, they're both touching their lines. Which one is going to break? I don't know. But I know gold is looking okay now, and the dollar is just kind of, lollygagging around here, and has for a couple months. The fact that it hasn't just completely rolled over yet is probably a positive for the dollar. But again, it is at a major inflection point, and gold is too. So we're just going to continue to keep our eye on that to see, which one. So this is, clear as day. S&P relative to emerging markets. Yep, you want to be in U.S. stocks. S&P to world stocks. Yep, you want to be in S&P 500. Small caps versus the dollar. Small caps versus S&P 500. Small caps are smoking the S&P 500. So if you're a bull, you might want to be long small caps. If you think the dollar is going to continue to rise, because typically small caps will follow the leadership of the dollar. So I like this chart because it has so much on it, and it just kind of shows you everything. And me, I'm going to be in the strongest one. I'll completely get out of VEU and get myself an SPY at the drop of a hat if I'm seeing these relationships start to shift, because they can last for years and years to come. So remember this, right? The dollar is right here. Let's just go to the gold chart real quick. Whoops. Where are you? Okay, so let's start with GLD, right? Gold miners is up today. So GLD, it came down to 117.40. And that created a bottom, right? A potential support zone. Was it yesterday or Monday? It came down and touched 117.40. It came down to the exact dollar. So around 118 bucks, 117 bucks. This is like the dollar, except for inverse, right? They're just opposite of each other, right? Gold is at support. The dollar is at resistance. Gold is starting to bounce a little bit, and the dollar is starting to pull back. So I don't know if this is support or if it's going to roll over and break or not. But all I'm saying is there's an opportunity in gold, in my opinion, a low risk opportunity to take a stab at it. And if it works, great. If it doesn't, so what? You only lost 2 to 3%. To me, I think there's more upside here. So, maybe look at some gold stocks. If miners break this pivot, you're out. But I mean, right now you're what? Maybe you're about 4%, but it's getting on this downtrend line, and I would say that it's breaking this downtrend line. Let me kind of draw one real quick. Say it's breaking that downtrend line. The miners relative to the price of gold has already broke out, right? It broke out a couple of weeks ago. And then you have the dollar that's, again, at the resistance and pulling back a little bit. I wouldn't say this is cracking or anything like that, but this is what's interesting to me. It's something I learned off Greg Schnell with stock charts. You know, he likes to follow gold when the miners are breaking out relative to the metal. And they broke out, and then GDX is starting to get strong. Gold found I mean, this is a couple of days old, so we don't know what's going to happen to this. And the dollar is just kind of hovering in this resistance zone. So it's just, it's all very interesting, and just, you know, kind of given the latter part of the business cycle, commodities are strong. We know oil is strong. We're going to look at that here in a second. So I want to go to XOP. Where is that? So XOP is stronger. The exploration and production is stronger than XES. So, and I got shaken out of an oil stock, but we can just kind of draw on this for a second, because I see a little cup and a little handle, and boom. So it's kind of interesting right there. But you have here's what I'm unsure of. You have West Texas that's at 74 all the way up here. It keeps, I mean, it came all the way, I mean, if I draw this longer chart, it was in the 40s, right? Just keeps grinding higher. Consolidates, you think it's going to crack, breaks trend lines, and then heads higher. Consolidates, you think it's going to head higher, and then breaks out. So oil is strong. You have just these monster move in XOP, right? 31% from here. You could say it's 35%. It stayed above the 50-day moving average. In my opinion, it's choppy, but man, that's commodities for you. Commodity stocks, they're volatile. That's why I don't always like trading them, just because the volatility in the stocks are always just going to follow what the commodity itself is doing. But this is looking all right, and it's kind of hard to not be bullish on oil because it just keeps breaking out. It keeps breaking out. You don't know how high these are going to go. Here's where I'm struggling. You come down here, and I have the XOP relative to the West Texas crude. So you have a nice rise here, but really the last, say, 2 to 3 weeks, the oil has done better than the oil stocks. So I don't really, I like to see this. I mean, you want the oil stocks outperforming oil, and it's been pulling back. So could this curl up? Absolutely. It broke out of this downtrend line right here, came back, tested it, and then just went on a nice run. Okay. Now both oil is at a high, 52-week high. This is almost at a 52-week high. I mean, you're a couple points away. But this continues to underperform over the last 3 weeks. So I'm just kind of scratching my head on what to make of that. And maybe there's just no perfect setup, right? You just kind of have to take it for what it is. But it's something that I'm paying attention to, very much so. Whoops. Okay. Yeah, here we go. Okay, so the VIX, I'm definitely keeping my eye on the VIX because, you obviously have the spike right here. It's been coming down, so there's nothing to worry about. And I think when it's under 15, when it's above 18 is when you really need to start paying attention, or when it's creeping higher and continues to reverse in the latter part of the day. It's just something, when it gets above 18, definitely when it gets above 20, I probably just hold off on new trades unless it's just like an obvious reversal. But it's just something to keep an eye on. Right now, it's tamed. But that could change very quickly. We have a Fed meeting today, so it always seems like the market goes the other way. And the market's up this morning, so we'll kind of see where it ends. So right now, the percentage of stocks at the S&P 500 above the 20-day EMA are right at that 60%, right? So to me, it's still slightly bullish. I wouldn't say that's bearish, but if it cracks wide open, this is always something I want to pay attention to. The percentage of stocks above the 50-day moving average are about half. So again, I try to pay attention to this one because you can see if you go down the 20-day moving average, you get just all these, crazy signals, and I'm not going to trade that often. I'm not going to trade on breadth indicators. It's more of a, if we do get a pop and the market starts rising, is this breadth rising with it? Because if it is, that's going to give me more confidence. If it's not, I'm going to be like, I might hold off a minute, or at least take half positions and be incredibly cautious. And if I always, if you have a couple of losing trades, you always just want to start to trade a little bit smaller, keep your risk reward until you're in a more favorable environment. Breadth, GDX, XL. Okay, I want to look at, actually, let's go to the sector summary. Let's do that. Okay, so the NASDAQ, it's giving back a little bit. It's kind of holding in there. That's okay. So let's look at, all right, technology's up, consumer staples up, which is kind of odd. Let's go to the perf chart because I just like that visual better. Get that off. So let's look at what sectors are the strongest the last 20 trading days, about the last month. Utilities, staples, that's not really good. Financials and industrials are getting clobbered. Cyclicals are actually positive. But for the most part, I like to see, okay, what's up the most, what's down the most. You got consumer staples and utilities. Those are defensive sectors. Industrial, financials, those are the opposite. You want to see some of these leading the market. Technologies just seems to be leading the last several years, but eventually you need to see financials lead the market, and that's not happening yet. Maybe that could switch, but we'll wait and see. Okay, so in the last 5 trading days, this is excluding, this is June 20. Why is this June 28th? I don't know. Okay, so utilities continue to lead. Oh, this was last week. Okay, so, and this was last week. Utilities again, financials down, energy bouncing a little bit, but again, don't worry about the day by day, but there's a common theme that utilities are starting to come back a little bit, and we definitely don't want to see that. I can't imagine that would be a positive for the market. If we go look at actual utilities, let's look at XLF for a second, the financial ETF. Well, this looks like it's going to break. I mean, if I draw a trend line right across here, it's in it. And if this breaks, I don't think that's good for the overall market. You got a descending triangle right here. You could draw a trend line right here. You could draw a trend line right here. Breadth is getting weak in the financials all day. So I'm just, until it breaks, I'm not going to be too bearish, but I'm just saying this gives me a little bit of caution. Let's look at XLU, which is the utilities. This is the only thing looking pretty strong, probably riding a 5-day moving average right here. Money is piling into utilities. Maybe it has to do with interest rates. Maybe it has to do with just the summer months. Probably a little bit of both, because interest rates pulled back slightly, but nothing to write home about. But you can see there's accumulation, there's breadth in the utilities. Man, it's just, I'm not a fan when utilities are just starting to lead the market. Now, one thing I wanted to do is I wanted to look at some commodities real quick. So you have the gold miners, the copper, oil and gas, and the XME, okay? So let's look at the last 20 trading days, and this goes through July 3rd. So I wonder if I could get a, can I get an S&P 500? Why is, here, let me get an S&P 500 on here, just kind of compare. Nope, come on. Okay, so in the last 20 trading days, you really have oil and gas that is the strongest, and that makes sense because oil is up, right? Oil is at a 52-week high. So what I'm looking for, gold is, miners are starting to perk up, you know, the last few days, right here. It's kind of starting to break out of this little thing. But it's interesting because you saw gold, copper miners are going off a map. SLK, I wonder where that is, because that should be up here. But SLK isn't looking great either. So if we go up to the 5-day, so in the last 5 days, right, you have gold is up, and it seems like a lot of these are kind of pulling back. And let's see, what do we got here? Okay, so the S&P 500 is right here. So, you know, the point I'm trying to make here, let's go to, let's just go back to the last 20 days. So the point I'm trying to make here is that, you know, oil continues to be the strongest stocks of the commodities. This little one-day pullback's no big deal. Gold, I think, is starting to perk up a little bit, but you still have these industrial commodities that to me just aren't looking very good. As a matter of fact, looking incredibly weak. So if we just look at a copper, I mean, there's nothing I want to do with this chart, right? There's just not. If we go to the SLK, is that? That's why I had the wrong. Give me just a second. Let's go to the steel. SLX, excuse me. So this is looking very similar. You could argue it's at support too, just probably with the CRB. But the industrial miners are looking weaker, and oil and gold are looking like the stronger of the two. So what I like to do is sometimes this Market Smith tool is really good for industry ranking. And what I'll do is I'll go and say, okay, what are, just from an industry ranking standpoint, what are the top 20? Okay, because I want to be in the strongest. And then I'll say, okay, what is creeping up the fastest, like as far as aggressive sectors? Because if I pay attention to, like, if utilities are creeping up, but what I want to see is what was really bad and is now really good. So this computer software medical is really sticking out, because 3 months ago it was 127 out of 180, I think, and now it's in the top 5. That's interesting to me. You have this commercial services advertising 3 months ago was towards the bottom quartile, now is looking like it's in a very early move. Also interesting. And then retail jewelry is kind of popping out to me. But let's go look at just a few of these top stocks. So you have Viva, Aetna. Let me look at the sector real quick. Stocks and group. Top stocks. So you have this Simulation Plus. Just kind of go look at some of these. View stocks and sector. So you have all these stocks, and a lot of times what I like to do is, so they're ranking them by relative strength, but I like to see, okay, what's happening. A lot of these have already made a really big move, but it's nice to kind of look at, see what is continuing to be strong, what's kind of holding up in this market. Like you have Adobe right here that just, that's a fairly easy hold if you were to hold it. The Simulation Plus is looking interesting because it consolidated for about 6 to 7 months and then broke out. It's pulling back a little bit. Got a new CEO right here, but that looks like a pretty bullish setup. CRM, it looks like it's just slowly grinding its way higher. Palo Alto looks like it's consolidating right here after a big consolidation. Look, it just broke out of this, what was that, 3-year consolidation, and is now sitting on top of that. So it's just a few stocks in here that's kind of looking interesting. Let's go back to the top, and I'm just kind of curious, what is, okay, Netflix, IQ, yeah, that makes a lot of sense. Let's look at some of this, what else? Commercial advertising. Let's just grab a stock and see the stocks in this industry. Okay. So Trade Desk is an interesting one, and I really am looking for a consolidation or some kind of entry on this one. Now, I'm not telling you to go out and buy these, do your own homework. We're looking for stocks that are in sectors that are all of a sudden strengthening in the last 2 to 3 months after being beat down. This Trade Desk, this is actually hurtful to watch because I bought it way down here, and for some odd reason I got bored and sold it somewhere in here, and you know, the rest is history. So it's tripled. It's tripled since then. I made a little money, but look, it really gapped out of here on, 50%, and doesn't really seem phased at all by the pullback. So I have this on my watch list, and it's just kind of something to watch. Now, a lot of these stocks, they're already long gone, but so like this one right here, this Criterio, you have year over year, I'm looking at the earnings, it's going from negative to positive next year. Nice return on equity. It's been beaten down. Accumulation is starting to come in it, so I might look for a pullback or a consolidation. Kind of an interesting setup. So it's interesting a lot of times to me. Let me get this up here. Okay, so trying to get back to this, so you can see what is towards the top. Still, I mean, this just goes to show you that most is in the top 20. I mean, these are aggressive sectors. These are aggressive industries. Excuse me, retail coming back towards the top after being down a long time. Look, retail department stores, and they got a long way to go to even get back to their 2015 high, so they could make a run for a while. A lot of computer software is worth noting. So the aggressive sectors, in my opinion, are still leading, and you haven't quite had utilities or anything, you know, in the last 12 months come up in the top 20 yet. So the market is incredibly vulnerable right now, but we are still in a bull market. And I think just looking at all these sectors will go to tell you. And retail, office supply, there's not a lot of stocks, good stocks in this. What is that? I'm just kind of playing around. But this just goes to show you sometimes it's, oh, that's because it was bought out. Anyways, it just kind of goes to show you, you know, what is here. So I hope this was helpful. Pay attention to what happens after the announcement of the Fed meeting. You know, gold tends to move right after it. The market tends to move. So we'll just kind of wait and see.